Hey everyone, this is Michael with themichaelblank.com. So in this video I want to talk about paying yourself as the syndicator. Syndicator meaning you're putting a deal together with a group of investors. So you're doing a lot of work, right? So you're looking at deals and you finally have one on a contract, which means you probably looked at a ton of deals to get to that one. Then you're doing all the due diligence. Maybe you're even putting up money, your own money to complete the due diligence. You're closing the deal. You're managing it, you're managing the manager, you're adding value to everyone, and then you're going to sell it hopefully for a profit. So you're doing a lot of work, and you're adding value for everyone. So you should get paid. So there's three ways you can get yourself paid with syndication. One is up front when you close to purchase the property. Number two, while you own the asset, and number three, when you dispose of it. So in this video, I want to use the syndicated deal analyzer to show you how that's done and what impact that has on the overall returns. All right, let's get started. In today's video, we'll continue looking at a 44 unit deal with a focus on how to pay yourself. So here's our unit. What we did in previous videos is we took the financials and we applied them to our syndicated deal analyzer. We structured the deal where we gave the investors 5% preferred rate of return and split the profit 50-50, which currently gives them a 13% return. All right. Now, the next thing we want to do, of course, is we want to see, hey, how much are we getting paid here? So we'll look at the returns in the 5 years, and you see here the first section is what the investors are being paid. And there's a section down here which shows what you're being paid for cash flows and returns, the way we've currently structured the deal. And you see here that per year on this deal we're getting paid between $20,000 and $34,000, and at closing our expected profit is going to be close to $300,000 for a total gain of $550,000 over 5 years. So that's kind of nice. Now there's other ways. So we're being paid as an equity partner. So right now the way we have it is we own 50% of the building after the preferred rate of return is paid out. All right. So there's other ways we can pay ourselves. One is we can pay ourselves an acquisition fee at closing. Right now that fee is 0. What happens if we paid ourselves 1%? That's $24,000 at closing, and it reduced the total return, of course, a little bit. Why don't we pay ourselves a little more? Now we're down to 12%. What if we paid ourselves 3%? All right. Now we're the returns are just under 12%. All right, still in our margins, not as great. You know, maybe what we can do here is we can tweak this model and give the investors more. Okay, so now we're at 12.3. Now what does this do to our returns? You know, now we're paying ourselves between $16,000 and $30,000. A total gain of $450,000. So we're getting paid a little less over the life of the investment, but we are paying ourselves $72,000 at closing. Maybe do a compromise and make this 2%. Now we can also pay ourselves an asset management fee, which means that over the amount invested, $1.1 million, we want to charge ourselves 1% during the life of the investment. And you can see that here. In our P&L, you have the asset management fee, which is 1% of the total invested dollars, which is $1 million. So $10,000 a year is being paid to us, and that comes out before any kind of preferred rate of return or equity split. The other thing we can do is we can pay yourself a capital transaction fee or a disposition fee at closing. Right now it's 0. If we pay yourself 1%, then you can see here it reduces the returns down to 12%. But if we go to the sale tab, you can see that we're paying ourselves 1% of the sales price, which is basically like a commission of $33,000. All right. So this then juices are the return. We have the capital transaction fee here, the net proceeds from the sale. So we're now getting a total profit of $541,000. So those are different ways that you can pay yourself, and you can tweak this thing a little bit to not only pay yourself a reasonable fee for putting a deal together and managing it and selling it for a profit, but also for achieving your investor returns. Anyway, I hope that was helpful. I'll talk to you later.